when I think about the tail wagging the dog to this market, I want to ask about the bond market because, yes, fine, we're heading into a big week of economic data where you have yields on the rise today, but you take a look at the 10-year. Over the past month, you almost hit 4.5%, and now you're back closer to 4.2%. And where do you think ultimately this goes? I mean, how much fuel could potentially lower yields than initially expected really feed the market?
I think in terms of moves up and down in, say, the 10-year Treasury yield and impact on the equity market, I think it's a function of what is driving yields. When yields become quite connected to the inflation story, both on the upside and the downside, that tends to mean you're in a backdrop of an inverse correlation between bond yields and stock prices, meaning higher yields on the back of higher inflation, negative for the equity market. But when yields are connected more to the growth outlook, that tends to be a more positive backdrop for equities. If you look at, say, one-year correlation between bond yields and equities, we're still in that inverse territory. But if you shorten that to the past few months, you're slightly in positive territory. And that's because bond yield moves have been a bit more connected to the growth side of the equation, not the inflation side of the equation. So I think it's the background behind why bond yields are doing what they're doing that drives whether equities perform better or worse in either direction.
Lizanne, investors seem very excited about Trump tax cuts and deregulation, but they, I guess, kind of push aside worries about tariffs and deportations. Why do we only consider the good, potential good, and not the potential bad?
I think we should consider everything, and I think that's part of the reason why we continue to have cross currents. Taken at face value, if you look at the combined effects of deportations and higher tariffs, it's hard to argue against that being somewhat stagflationary. Upward pressure on inflation, lower pressure on growth. You're right, though. If corporate taxes are cut, you get a laxer regulatory environment, all else equal. That's better for corporate side of America, better for corporate profits. We are an importing nation, so any improvement that you see there in areas like lower taxes actually can work in contrast to the effect on things like the trade deficit of higher tariffs and more deportation. So I think we're all there's so many mixed signals heading into the start of the administration. I think it's really hard to put a finger on what this means for the inflation backdrop, what it means for the growth backdrop. And it's part of the reason, notwithstanding the better ISM news, and we actually think and have posited that we were going to start to see an easing in some of these bifurcations with maybe manufacturing starting to stabilize and actually catching back up to what has been stronger services backdrop. But we have seen things like capital spending intentions stay fairly muted. And I think that's in large part due to the massive uncertainty with regard to what was on the campaign platform and what actually will become policy post-January.
Heading into the end of the year, at this juncture, what would be your favorite trade?
I think you want to stay factor focused, and heading into the beginning of next year, I think the shift that's going to be important from a factor standpoint is a shift from level mattering to rate of change mattering. So if you look at things like interest coverage, strength of the balance sheet, free cash flow, profitability trends, those were successful in level terms, good versus bad. I think it's better versus worse that matters more in those factor-based screening methodologies, looking for companies that have improving profitability, that have improving interest coverage, particularly if the Fed continues in the easing mode. So I think it's somewhat subtle, but I think that's an important shift to consider as we head into the end of the year, into the beginning of next year.